Good evening, Garage Gang. It's Monday, December 1st. We're back in the garage, and welcome to your nightly market recap. End of QT day. The Fed just turned off the money vacuum. The piggy bank is rattling on empty, and half of TradFi is out here calling this orderly with a straight face. In a world where the central bank's gas tank is on E, where Bitcoin gets thrown down a flight of stairs, and where AI is quietly rewiring the entire global economy, you're not here for their bedtime story. You're here because you want the real read on this chaos. And of course, you know who's steering this ship tonight. Avatar John, your guide in all of this mess, the guy who looks at a 5% Bitcoin nuke and says, relax, slide your chair up. We're going to break this down so your gardener, your barber, and your cousin who buys every top all walk away saying, oh, now I get it. No jargon shield, no hedge fund riddles, just straight garage talk. We're going to walk through the Fed's empty piggy bank, why the end of QT actually matters, who just got margin called into oblivion, and which coins refused to die when the market threw them down a flight of stairs. But wait, and oh yes, we know the question on everyone's mind. Did Triple X get back in the trench? Well, just like he said last night on his way out, it's the first, and I've got bills to pay. You know how this story goes in the garage. This is where it all starts over, hero to zero and back again. So yes, we've got his plays lined up for you, but first do the garage a favor, smash that like, hit the follow, and come on, man, share this with your fellow Deegans. We really are building this channel one Deegan at a time, and you're part of the crew. All right, let's start at the top, the Fed piggy bank and the end of QT, because that is the backdrop for everything you saw on the screens today. When I say the Fed piggy bank is empty, here's what I mean in plain English. For years after COVID, the central bank was in money sprinkler mode. That phase is called QE, quantitative easing. QE just means we print money, we buy assets, and we flood the financial system with cheap cash. They bought government bonds, they bought mortgages, they pumped cash in. Think of QE like opening every fire hydrant on Wall Street at once. Water everywhere, stocks go up, houses go up, crypto goes to space. Everybody feels smart. Then inflation went crazy and they slammed the shifter into reverse. Enter QT, quantitative tightening. QT is the exact opposite of QE. Instead of adding money, they drain it out. They let bonds mature and don't replace them. They shrink the Fed's balance sheet, garage version. They stick a giant hose in the deep end of the pool and start quietly sucking water out month after month. Now there's another piece of this game called RRP. You'll hear suits drop it like it's normal. Yeah, RRP balances are down, blah, blah. Hang on. RRP stands for Reverse Repo Facility. Reverse repo is just the Fed's overnight parking lot for big money. Big players like money market funds, giant institutions like have extra cash lying around. They don't want it sitting there doing nothing. So the Fed says, give it to us for the night. We'll hold it safe. We'll give you a tiny return and we'll take securities as collateral. That overnight parking lot, that's the RRP piggy bank. At the peak, that piggy bank had trillions in it, literal trillions. It was the emergency stash. As QT kept draining the pool, that RRP piggy bank got raided to plug holes everywhere else. Money left RRP to cover deficits, bond auctions, risk-taking, and all of it. Fast forward to tonight, QT has been running. Bonds have been rolling off. The RRP bucket has been drained. The piggy bank is basically empty. So where are we now? QE is over. No more fire hydrants. QT has drained the pool. The water level is low. RRP, the emergency stash, is dry. That's why I say the bucket's dry, the gas tank's low, and if they keep vacuuming, something's going to snap. Now here's where your Deegan brain perks up. So we ended QT. Does that mean we get QE back? Think of it like driving. QT is reverse. You're slowly backing away from the party, pulling money out of the system. QE is first gear. You drop it into gear and hit the gas, pushing money back in. Ending QT just means we took the car out of reverse. That's good, because at least we're not backing over our own foot anymore. But we have not slammed it into first yet. We're sitting in neutral, foot hovering over the clutch, engine idling, everyone on X screaming, either park it or floor it, bro. To really feel that stupid easy bull market again and the one where everything green candles at once, you'd need some version of QE back. The Fed buying bonds again and the balance sheet growing instead of shrinking. Fresh liquidity pouring in, not just, hey, we stopped draining. That's why the talking heads say ending QT is good, because the drain at the bottom of the pool is finally off. The Fed looks less hostile to risk. Bond and credit markets can actually breathe a little. Traders feel like the Fed might one day put the car back in first and give this thing some gas. But here's the garage truth. Ending QT doesn't refill the pool. It just stops it from getting shallower. We're still in a shallow pool. So when a whale cannonballs in or a bunch of degen longs get liquidated, the waves are huge. That's why in this environment, when someone dumps size or gets margin called, Bitcoin doesn't glide down gently. It drops like an elevator with the cable cut. And that is exactly what you watched on your screen today. Now that we've cleared up QT, RRP, and QE, let's get into how that macro backdrop turned into those violent moves in Bitcoin, DeFi, and the microcap trenches tonight. First stop is the main character of this whole circus, Bitcoin. Right now, Bitcoin is sitting around 86,300 and change after tagging an intraday high near 87,165 and flushing down into the low 80s earlier in the session. So yes, Bitcoin opened December by getting shoved down a flight of stairs. You did not watch a healthy pullback. You watched a stress test, 5 to 6% straight down, around $640 to $650 million in leverage positions liquidated in 24 hours, with the vast majority of that coming from people who were long. Meanwhile, the S&P and the NASDAQ down maybe a third to 0.5%, annoyed, not panicked. That tells you everything. This was a crypto-specific deleveraging, not a full global risk meltdown. Now, if you only listen to headlines, you'd think Japan crashed crypto. They'll tell you Bank of Japan might hike, the yen carry trade is unwinding, macro jitters, end of the world. Let's translate. The Bank of Japan hinted at a rate hike. Japanese bond yields, 2-year, 10-year, jumped to levels they haven't seen since the mid-2000s. The yen strengthened. Why does that matter? Because a lot of big players have been running the yen carry trade, borrow super cheap in yen, take that money and spray it into anything with higher returns, stocks, bonds, even crypto. When Japan suddenly looks less like free money forever, that carry trade gets squeezed, funding costs go up, people start closing risk positions just to plug the hole on the yen side. Crypto, being the biggest casino in town, is the first thing they throw overboard. So yes, Japan absolutely threw a punch. The funding shock from BOJ repricing hit an already over-levered crypto stack and lit the fuse. But look at what didn't move. US 10-year yields roughly stable. US indices gently red. Gold grinding up near all-time highs. If global liquidity had truly been rug pulled, everything would have been on fire. Instead, what we got was a Japan-driven rate shock colliding with thin early December liquidity and a bloated derivatives book in crypto. This was a BOJ-assisted leverage flush, not a full macro rug. Now let's talk winners and losers. Winners first, derivatives exchanges and market makers. Every liquidation is a fee. Every forced sale is a spread. 600 million to $1 billion in liquidations in a day, that's their bonus pool. Short biased and vol long funds, the guy sitting in puts, short perps, or long volatility finally got paid for weeks of boredom. Slow money, ETF and ETP accumulators, after a record November of outflows, digital asset products just printed over $1 billion. Net inflows into Bitcoin, Ethereum, XRP products. Right as retail puked, the boring money started nibbling. Losers, over-leveraged perp traders and retail longs, they don't have a motive. They're the meat. High beta altcoin holders and crypto equities, Solana, XRP, the usual suspects. Most of them took bigger percentage hits than Bitcoin. Yen-funded carry traders. When Japan turned the screws on yields, their low-cost funding leg broke, and they had to unwind risk, crypto included. Now, here's where it gets interesting. And by interesting, I mean this is where most people completely misread the room. On the surface, every fear gauge is pinned. Crypto fear and greed is in extreme fear. Your feed is full of its overthreads. And every armchair genius is yelling that we still have leverage to flush. But under the hood, the math does not match the panic. Open interest, all those futures and perp tickets, is already down roughly $20 billion from the peak. That is 20 billion of ammo gone. Funding across the big venues is flat to slightly negative. Not euphoric, just scared. Those same ETFs that bled all November, they just quietly flipped back to net inflows. So the contradiction is simple. Price looks terrifying. Sentiment feels catastrophic. But a lot of the fuel for another straight line waterfall has already been burned. We already purged a chunk of leverage. We already took a chainsaw to the most stretched players. And we already shifted from greed to extreme fear while slower, bigger money started buying the dip through spot and wrappers. That is why the next 72 hours are two-sided, not pure doom. Base case, choppy, disrespectful consolidation with a slight lean to the upside. Bitcoin grinding somewhere between the low 80s and low 90s, faking people out on both sides. Bear case, one more stab at that 80,000 floor if Japan or United States data throws another grenade. Bruised, not dead. Step off the Bitcoin highway and look at DeFi. Total value locked. The money parked in protocols is down a bit over 30% since October, around $55 to $57 billion pulled out, with another 12 to 16 billion yanked this past week. On the surface, it looks like DeFi is dying. Zoom in and you see the truth. Simple primitives, staking, swaps, plain lending, names like Lido, Uniswap, Aave, Compound Maker, held up or even clawed back value. While over-engineered, clever yield products, anything hacked, depegged, or Ponzi-flavored, got marched to the guillotine. Money did not just leave DeFi, it rotated from fancy to functional. Simple rails survived, complicated games blew up. And while all of that was happening in crypto, something else was moving. like it owns the future. AI did not care that your chart was red. It did not stop for your liquidation. It just kept taking ground. AI-driven traffic into e-commerce went vertical into Black Friday and December. Online sales hit roughly $11.8 billion in a single day. Across the month, AI-powered traffic rose more than 1,200% and converted about 16% better than normal browsing. Translation: the shopper using AI, the assistant, the recommender, the deal hunter, is far more likely to hit buy now than the shopper wandering around blind. Retailers got the message. AI is no longer a widget. It is the front line closer. At the same time, AI chat apps are putting up numbers most crypto projects would sell their soul for. Gemini downloads are up around 4 times since August. ChatGPT is still ahead with tens of millions of downloads a month, hundreds of millions of weekly users, and over $10 billion in revenue after only 3 years. That is not a product. That is an infrastructure layer. Then come the side stories that are not really side stories. Chinese parents literally pointing a phone at their kids and letting AI watch homework, posture, eyes, fidgeting, barking, sit up straight, stop playing, focus. That is not cute tech. That is home surveillance rebranded as study help. Disney getting ready to let Disney Plus subscribers generate AI fan videos with Darth Vader, Iron Man, Elsa inside an official sandbox. They watched bootleg AI mashups steal attention on TikTok and YouTube and decided to pull the whole game inside their own walls with their rails, their rules, their data. So let's stop pretending this is cute. Here is what is actually happening. AI is becoming the default way people search, shop, study, and create. Kids are being trained by AI voices as much as by parents and teachers. Your favorite franchises are about to live inside AI-powered worlds you help generate. The most powerful consumer apps on earth are no longer social networks. They are AI assistants. And here's the part nobody wants to say out loud. This does not slow down because you are uncomfortable. It does not wait for regulators to catch up. It does not politely ask if your job, your business model, or your coin narrative is ready. AI is going to sit between you and everything, between you and your money, between you and your news, between you and your kids' education, between you and your content, between you and the market. If you do not understand it, you are not just behind, you are a passenger. In that world, AI infrastructure in traditional finance, the chips, the clouds, the platforms, and AI narratives in crypto, compute tokens, data networks, agent coins are not meme rotations. They are the rails for whatever this next version of life looks like. So while crypto spent the day as a punching bag for rate chatter and leverage, AI spent the day quietly tightening its grip on the real economy, moving one step closer to being the filter, the gatekeeper, and the engine behind almost everything you touch. You can either treat that as a horror film or as the map, but pretending it is not happening, that is the only guaranteed way to get run over by it. While that whole fight was happening in crypto, something else was moving like it owns the future. AI. AI did not care that your chart was red. AI did not stop for your liquidation. AI did not pause to check if your bags were okay. AI just kept taking ground. AI-driven traffic into e-commerce went vertical into Black Friday in December. Online sales hit roughly $11.8 billion in a single day. Across the month, AI-powered traffic was up over 1,200% compared to last year and converted about 16% better than normal browsing. That means the shopper using AI, the assistant, the recommender, the deal hunter, is significantly more likely to hit buy now than the shopper wandering around blind. Retailers got the message loud and clear. AI is no longer a widget. It's the front line closer. It's sitting in front of the product page saying, here's the best deal, here's the best option, here's the review summary, here's the comparison. Stop thinking and just check out. At the same time, AI chat apps are putting up usage and revenue that most crypto projects would sell their soul for. Gemini downloads are up 4 times since August, pushing toward that 60 million plus monthly zone. ChatGPT is still ahead with around 85 million monthly downloads and hundreds of millions of weekly active users, doing over $10 billion in revenue 3 years after launch. That's not a product. That's an infrastructure layer. Then come the culture shots. Disney is about to let Disney Plus subscribers generate AI fan videos with licensed characters, Darth Vader, Iron Man, Elsa, the whole roster, inside an official sandbox. They watched bootleg AI mashups steal attention on TikTok and YouTube. Now they're building a machine where you create inside their walls, on their rails, with their data, their terms. Streaming isn't just press play anymore, it's press generate. So put this first half of the picture together. Artificial intelligence is driving billions of dollars in retail. AI apps are commanding insane engagement and revenue. Legacy giants like Disney are rebuilding their platforms around AI native interactive content. That's not a feature. That's a new front end for the economy. Now let's talk about the part that should actually make you sit up. How deep this thing is about to get into your life. In China, parents are literally pointing a phone at their kids and letting AI watch them do homework, tracking posture, eye movement, fidgeting, and barking. Sit up straight, stop playing, focus. That's not gee whiz tech. That's household surveillance rebranded as study assistance. Your kid isn't just being watched by mom and dad anymore. They're being watched by an algorithm that never gets tired, never blinks, never stops. Now stack that with what we just talked about. AI deciding what you see when you shop, AI deciding how your kids behave when they study, AI turning your favorite franchises into co-created worlds inside closed ecosystems like Disney Plus. And don't forget the top of the funnel, Gemini and ChatGPT aren't just apps. They're becoming the default interface for how humans ask questions, get answers, write, code, plan, and think. So here's the real picture. AI is sliding between you and everything, between you and your money, between you and your news, between you and your kids' education, between you and your content, between you and the market. If you don't understand it, you're not just behind, you're a passenger. And in that world, AI, infra, and TradFi, the chips, the clouds, the platforms, and AI narratives and crypto, compute tokens, data networks, agent coins are not meme rotations. They're the rails for whatever this next version of life looks like. So while crypto spent the day as a punching bag for BOJ and leverage, AI spent the day quietly tightening its grip on the real economy, moving one step closer to being the filter, the gatekeeper, and the engine behind almost everything you touch. You can treat that as a horror film or as a map, but pretending it's not happening, that's the only guaranteed way to get run over by it. Okay, now we're in the moolah section for real. Triple X walks into the night with 1 ETH earmarked for base and 50 SOL for Solana. That's the whole war chest. No leverage, no fantasy fund, just that. And he's not chasing mystery contracts tonight. He's sticking to established projects, stuff that's already survived a few cycles. So he's not sweating rugs. He's watching flow, timing, and volume. For base, it's all over Deck Screener. Where Axion doesn't give him what he needs on that chain. So he treats Deck Screener like his radar and his rear view mirror. He chops that 1 ETH into a few smart pieces. Roughly half an ETH goes into the base index play, Arrow. He's not FOMO buying green candles. He waits for it to get smacked, watches it bleed into a level that's actually been defended before, and then steps in when the candles are red. But the volume is still there, and the order book isn't hollow. Then he peels off around 0.3 ETH for virtual. Same idea. It takes a real hit, stops falling, starts carving a higher low. He's watching the short time frames on Deck Screener. Is the selling slowing? Are buyers showing up on dips? Is the bounce clean instead of a single scam wick? The last couple tenths of ETH he uses like a scout. Little 0.05 to 0.1 ETH probes into base names that are actually trading. Decent liquidity, consistent volume. No obvious god wallet sitting on half the supply. If the flow feels fake or it stalls out, he's gone. If it behaves, he feeds more into the winners and starves the losers. That's base. Pure tape reading, no heroics, no all-in nonsense. On Solana, it's a different cockpit. Here he's got Axion and Deck Screener working together. Deck Screener shows him the candles and tempo. Axion shows him what the wallets are really doing. He takes that 50 SOL and breaks it up. Maybe 10 here, 8 there, 5 somewhere else, spread across names like Fartcoin, Zerebro, KTA, Kabuto, Dnode. Nothing insane per position because he wants room to add if he's right and room to walk away if he's wrong. The pattern is always the same. First, he waits for a proper slap, not minus 5%. I'm talking a real 20 or 30% flush. Then he watches, does price actually stop bleeding? Do we see a proper bounce and a higher low? Does volume stay after the first green candle, or does it vanish the second people try to exit? If Deck Screener says the structure looks real, he opens Axion and checks the guts. Who bought that dip? Are new wallets stepping in, or is it just the same 3 addresses passing the bag back and forth? What do the top holders look like? Is it spread out enough, or does one wallet basically own the chain? If both tools agree, healthy holders, clean volume, real bounce, he starts with a small 3-5 SOL position. If the next move confirms, higher low, volume stays strong, no whale dumping into every candle, he adds more. If something breaks, Axion shows early buyers unloading or Deck Screener shows the volume dying, he trims or cuts it and moves on. No romance, no, but the meme is funny. By the time the night's done, that 1 ETH on base has done a full tour, rotated through Arrow, Virtual, and a couple of side plays. And he's closing the book with 2 ETH instead of 1. The 50 SOL that was hopping between those SOL trenches, in, out, add, cut, survive a few heart attacks, is now 83 SOL. And here's the part everyone skips in their screenshots. He doesn't leave it on the table. He flips the 2 ETH and 83 SOL into USDC. takes his chips off the floor and sends the moolah where it actually matters, off to pay the rent up. Session done, risk off, mission accomplished. That's what the plays look like. Not magic, not guessing, just sizing, flow, timing, and the discipline to shut it down when the job is finished. Fall right, Garage Gang, let's close this out with Lulu's read on the tape, nice and smooth. Today was chaos, candles everywhere, fake breakouts, trap doors, little rallies that died halfway. Most people saw noise. Lulu saw a hunt. She stepped into that mess like a savage and took her shots. A Bitcoin long around 83,933, a Solana long around 123, and a couple of quick scalps in between, just to remind the market who it was dealing with. Here's the short version of what she sees now. For Bitcoin, every time price dumped into that 83 to 84,000 zone, selling slowed, candles stopped free falling, and the moving average ribbon started catching price instead of chopping through it. That is where she leaned in. From here, hold that 83 to 84,000 shelf and close back inside and above the hourly band. She is looking for a grind into the 87 to 89,000 area. Reclaim and hold somewhere in the high 88 to low 90,000 range. The move stops looking like a dead cat bounce and starts looking like a real trend again. Lose 83,000 with strong hourly closes and real sell volume. The next steps down are around 82,000, and if that does not hold, we start eyeing 80,000 flat. Verdict, bruised, not broken. Above the mid 80,000 zone, she is interested. Below it, she is on defense. For Solana, on the short time frames, it was a roller coaster, but when Sol flushed back into the 123 area, a level that had already acted as support, the free fall slowed, momentum cooled, and buyers started fighting back. That is where she hit the long. Going forward, hold roughly 123 to 125 and climb back into the hourly ribbon. She is eyeing a push toward 130 to 132. Break and hold above about 135. Opens the door for a real move into the high 130s and toward 140, where she is happy to unload a chunk of that long. Slip and close below 120 with conviction. The floor turns into a slide, and the next likely stops are around 115, and if the market really wants blood, down near 110. So Sol is on a tight leash. Above the low 120s, upside is worth fighting for. Below that, the pig is slamming the brakes. For ADA, we keep it in cents. High 30-cent zone equals soft floor, low 40-cent zone equals ceiling for now. If ADA can sit on that high 30 base and ride the supportive band upward, a retest of the low 40s is on deck. Break and hold above those low 40 cents, and it can explore deeper into the 40s, lose that high 30 floor on ugly closes, and Lulu expects a drift back into the mid 30 cent area and a full rebuild. So Lulu's final map for the night: Bitcoin, protect that 83 to 84,000 shelf, reclaim the high 80,000 to low 90,000 zone if you want real momentum back. Solana, respect 123 to 125 as home base, push above 135 for serious upside, lose 120 and be ready for the drop. ADA, high 30 cents as the floor, low 40 cents as the lid, still stuck in the middle deciding what it wants to be. And now for anyone new in the Bay, let me say this clearly. By the way, none of this is financial advice. Just in case you are new here, the head of technical analysis in the garage is Lulu, and Lulu is literally a pig. 4 hooves, a tail, and a snoot that just happens to be freakishly good at sniffing out charts. If you choose to take financial advice from a pig, that is entirely on you. Garage Gang, go check out the website, gurucryptogarage.guru. It is free. Poke around. Tell us what you think. And most important of all, let